Good day and welcome to our webinar, our confidential report for the 3rd of June 2020. I'm going to begin as usual in America, where things seem to be returning to normality, at least from an economic point of view. The panic buying has stopped of clothes and accessories and so on, and sales are starting to lift slowly. In fact, sales of things like clothing have jumped 600%. Texas manufacturing outlook is up 34% in April. Road traffic is now down only 5% from the previous levels before COVID-19, and that compares with April's 13% down. Car sales are up sharply in America. Internal flights inside America are up 50%. And the weekly unemployment claims have fallen by 46% in April. They're still pretty high. The normal is about 350,000, and the most recent weekly claims was 2.4 million. So they still are very high, but they're dropping rapidly. The official unemployment rate in April month was 14.5%. You must compare that with the 3.5% that existed before COVID-19 started. And consumer spending took a 13.5% knock in April month, but it is rising sharply. And obviously their economy has significant surplus capacity. They've got enormous quantities of already trained staff and existing factories which are there but just standing empty at the moment. They are being brought back into production. Staff are being returned to their jobs and so on. And of course to that, you must add the huge fiscal and monetary stimulation which the American government has approved. And most of that, of course, is already discounted into the S&P 500. On your screen, you should see a chart of the S&P 500, as I've got it here, and the blue line represents a 200-day simple moving average. The reason I've put that on is because it's widely followed in America by a lot of investors. And here you can see the sharp downward trend. That point at the top there, that's the highest point, 3386 on the S&P 500, which occurred on the 19th of February. And you can see the market fell very, very sharply. Here on the 13th of February, somewhere around this point, we posted an article in which we predicted that this would be a V-bottom. And indeed, that is exactly what has happened. The V-bottom is now quite well established, as you can see. It went up very, very steeply, and then we had a period of what we call backing and filling, or a sideways pattern, period of indecisiveness. And then now it has broken up out of that sideways pattern, and it has broken up above the 200-day moving average. And as you can see, last night it closed at 3080, and that level means that it has recovered 73.4% of the downward trend. The downward trend was 1,149 points. 1,149 points. We have now recovered 73.4% of that. And we are just 9% below the all-time record high of 3386 made on the 19th of February. So this is no longer any kind of B wave. You know, in a bear trend, you often have an ABC formation where the market falls on the first leg, which is called A. Then there's a recovery called B, and finally a second major fall called C. So you have ABC. That is typical Elliott wave theory. But normally that B wave, that recovery wave, is never more than about 40 to 50%. So we are now at 73.4%, which means that it's highly unlikely that this is any kind of B wave. And in fact, what we predicted on the 13th of March this year, that it would be a V bottom, appears to be coming correctly. So obviously, one of the big benefits here, and one of the reasons why this is a V bottom, is because central banks have moved quickly and decisively, both on fiscal and monetary policy stimulation. They learnt from the 2008 subprime crisis. And even the European Union, which was so slow in bringing in quantitative easing in 2008, has not been doing any foot dragging this time. They've increased their quantitative easing more or less immediately. The American government has obviously cut interest rates to virtually zero. They've approved a $2.2 trillion fiscal package of stimulation. And the result of that is this V bottom that we're seeing here. So we expect that the market will continue to go up now, and that it will, in a relatively short time, it will break above this record high of 3386 and continue. And of course, that means that the great bull trend, which started in March of 2009, is in fact continuing. This cannot really be regarded as a bear trend in any normal sense of the word. It was not caused by economic factors, it was caused by a pandemic. And so its behavior has been very different from any previous bear trend. All right. So we think that there will be some significant changes, however, in the world economy. And the big sea change here is that the digital economy will take over from face-to-face business. This was already happening before COVID began. There was a move towards working from home. Amazon was employing a lot of people on a contract basis, paying them per hour, not taking them on as employees with all the legal ramifications that implies, but just employing them on a contract basis. Many consumers in America were working 2 or 3 or even 4 jobs for different companies on this type of contract basis. And I think that is now going to become a far more normal method of earning your living than having a formal job where you are employed and you have an employment contract and so forth. So the future of business is going to be qualitatively different. All right, now let's turn our attention to the South African economy. There's a consortium of people that advise the government at the moment, and they are making a prediction based on their models that the coronavirus will peak at between 40,000 and 48,000 deaths in November of this year. That is their prediction, October, November. They predict that we will run out of ICU beds by the end of this month, June. But of course, projections like this are always very conservative, and they are often inaccurate. But they are the best figures we have. Obviously, there's a huge backlog of testing, where the tests have been done but not assessed, and that tends to skew the figures. One interesting point, the mining community is getting back to work, and as they get back to work, they are bringing in and re-employing people from the local communities and from outside, and as they do that, they are testing every single employee. And in a mine in Mpumalanga, 17 asymptomatic cases were discovered. 19, and 17 of them were from the local community. At Mponeng mine, the deepest gold mine or the deepest mine in the world, it's a gold mine, 164 of the returning miners were found to be asymptomatic carriers of COVID. So that indicates that there are thousands of asymptomatic cases in the rural areas that have not been tested. It also indicates that the number of deaths is probably much lower than the average death rate around the world. So we have a higher number of cases but a much lower death rate. That's what it looks like. Of course, the strategy has always been just to buy time. The whole lockdown strategy was to buy time to enable people or the authorities to put in place the correct or necessary health facilities, hospitals, intensive care units, and so forth. We never ever thought that we would be able to contain and control this epidemic, this pandemic. We never thought we could do that. So we're buying time, and of course we're buying time at a great cost. There's no expectation that we will contain the virus, though. There are vaccines which are being worked on. There's one in America produced by a company called Moderna, and they've tested 8 people, and the results coming back from those tests of people who've been given this vaccination are that they have the same immunity as people who have recovered from the COVID disease. So they are now expanding that testing, of course, and they expect that the vaccine will be available by the end of the year. But of course, it will take time for that to be mass-produced, and I wouldn't expect it to reach South Africa before the middle of next year. So all we have done is buy time at an enormous cost. 2020 GDP projections are all negative. The Reserve Bank is now predicting that this year we will see a slump in GDP of -7%. The IMF is predicting -5.8%. The Treasury is predicting -16%. Business for South Africa is predicting between -10.3% and -16.7%. And they're predicting up to 4 million jobs lost. These are statistics predictions all based on economic models, which are also notoriously inaccurate. The immediate impact is, however, much lower tax collection. And nobody can say that the economy is not going to take a hit. It's definitely taken a hit. And the first result of that is a drop in tax collections. Edward Kayasweta, who's in charge of SARS, has predicted that we will collect 285 billion rand less than was forecast in the February budget. And of course, this lack of funds prevents the government from reviving the economy quickly. The deficit will have to be financed at higher rates because of the downgrade that we've gone through to junk status. But we are a paid-up member of the International Monetary Fund, so we should get a loan from them. Obviously, that loan will come with some strings attached to it. But we really don't have a lot of room to borrow more. We certainly can't increase taxes at the moment, and government spending cannot really be reduced while the corona pandemic is in place, because that would make the economy worse. So the only thing that really could be done is quantitative easing, the printing of money, literally. And it's been done extensively in first world countries in the subprime crisis. And in fact, even now, the European Union is doing a lot of quantitative easing. And we have room to do quantitative easing because our inflation rate is very low. We could print a lot of money without significantly increasing the inflation rate. BNP Paribas says that inflation this year could fall as low as 2.8%, which is below the lower level of our target range. Remember, the target range is between 3 and 6%. So we could bring that down to 2.8%, which means that we'll be below the lowest level. This gives us room to undertake some quantitative easing and improve the situation that way. But of course, the governor of the Reserve Bank, Mr. Kanyago, is dead set against it. But we believe it will happen sooner or later, simply because it's the only really viable option. There's enormous pressure on the government now to open the economy quickly. Business for South Africa is predicting anything between 3 and 7 million jobs lost. As we enter the stage 3, the number of cases and deaths is up. The squatter camps are starting to produce lots of cases, and they are obviously places where social distancing is almost impossible. And most of the people in those squatter camps, or a lot of them, have existing medical conditions. They are living in abject poverty, which means they often don't get enough food. So for a variety of reasons, we can expect the death rate to increase. And of course, we are going into winter. We should not forget that. And of course, now that we're at level 3, manufacturing is resuming. Most businesses are up and running. There's only about 20% of South African businesses that are not still operating. And the Reserve Bank is predicting that we will have a very sharp 3.8% growth rate next year, obviously off a low base. But that obviously is a result of us having a lot of unused capacity. In other words, during the COVID crisis and the lockdown, a lot of trained, capable people were retrenched. those people can be reabsorbed back into the workforce, and of course they don't need to be trained, and they can be put into factories which already exist. All they need to do is to start them up again. So what is being done to mitigate this crisis? Well, the crisis is definitely there. 60% of consumers indicate that they have had some sort of decline in their income, hopefully temporarily. Consumers have also pulled in their horns. They're paying off debt, they're hoarding cash, and that is likely to continue for a few months. The economic indicators which we use to evaluate the economy are all at radical lows in April. The market PMI, Purchasing Managers Index, was down to 35 from 44.5 in February. That's radical. And of course, anything below 50 is a contraction. Cash withdrawals at ATMs are sharply lower. Vehicle sales, including exports, have virtually stopped in April, but have picked up somewhat in May. And obviously, we expect vehicle sales to catch up. The lost orders from April will probably be bought in May and June and July and following months. The Monetary Policy Committee has cut our interest rates by 2.75%. They've done 4 cuts, but they say that further cuts are unlikely. This will have a significant impact, especially if it is sustained. Bondholders are paying now thousands of rands less in interest every month. Obviously, that is an opportunity. If you have a bond, this is an opportunity for you to save by maintaining your monthly payments and just allowing the capital outstanding on your bond to fall. But many people will decide to spend that extra money and so stimulate the economy. And of course, that is the idea which the Monetary Policy Committee has in mind. But many of those people have also lost their jobs. So it doesn't really help if you've got a lower bond repayment if you've also lost your job. And of course, at this time, the legacy of state capture has become critical, with many state-owned enterprises begging for cash. The Airports Company of South Africa now suddenly needs 11 billion rand. The Land Bank needs 22 billion rand in order to avoid defaults on 50 billion rands worth of government-backed borrowing. Eskom is earning about half of what it was earning because electricity consumption has halved. Denel can't pay its salaries. They will need cash from the government just to pay salaries. It is estimated that the government debt will double from the 6.8% which was predicted in the February budget. So it'll go up to 13 or 14%. So we feel it seems unlikely that President Ramaphosa will be able to avoid quantitative easing. And in the middle of all this, there is the astonishing debacle of South African Airways. The 5.5 billion rand which was given to the business rescue practitioners is gone, and according to Pravin Gordhan, that money was wasted. Gordhan and the unions are now talking of starting an entirely new airline, and this does not seem to make any sense to us at all. In fact, we regard it as risible. Who in their right minds would be trying to start a new airline now? Airlines are going bust all around the world. When was a government ever able to run anything as well as private enterprise? The expected cost of this is around 21 billion rand, and that to us is just crazy. Rather, they should pay Comair what is owed to it and take it out of business rescue. Comair can provide a very suitable and profitable airline as it has done for the last 75 years, without the need for spending 21 billion rand. I always thought that one of the only benefits of COVID-19 would be the final closure of SAA. One last point on the issue of the economy. Gwede Mantashe, our Minister of Minerals and Energy Affairs, has finally allowed municipalities to buy electricity from independent power providers. This is a sort of footnote. Nobody has really noticed it because it's in the middle of all the drama about COVID-19. But it is actually a very significant point, because now municipalities like the Cape Town municipality don't have to buy their electricity from Eskom. They can buy it from an independent power supplier. In the long term, that will have a huge impact. It will probably mean less power outages. And And it will be very significant. It will force Eskom to be competitive, if, of course, Eskom can survive. Obviously, what I've been saying here about the economy impacts directly on the long bond, the yield on the long bond, the R186, and also on the rand. So let's just quickly look at a chart there of the R186. Of course, when we had the pandemic, I'll just put a bit more data on the screen here. 2 years on. You can see here that prior to the COVID-19 event, the yield on the long bond was falling steadily as overseas investors gained confidence in the Ramaphosa administration. And then, of course, we had COVID-19, so the yield broke up through that trend line and spiked up to as high as 11% on the R186. Since then, the yield has been falling very sharply from about the middle of March, and it's been falling and falling and falling. One of the things that made the yield worse is the drop of 2.75% in the repo rate. That has obviously made our bonds less attractive to overseas investors. But the Reserve Bank has been in the bond market buying up bonds in order to generate some liquidity. And as you can see, the yield has now fallen well below the level that it was prior to COVID-19, and it is still falling. This indicates that overseas investors like South Africa, they regard us as one of the better emerging market economies, if not the best of them. So as they move from risk off to back to risk on, they are looking for a real return. And because we have a very low inflation rate, they see a real return here, despite the 2.75% drop in our interest rates. So the investors are rushing back into the rand. The yield on the R186 is falling quickly as a result of that. And of course, this impacts on the rand itself. So if we just have a look at that now. So here you can see the rand against the US dollar. You can see the support level which we'd achieved prior to COVID-19 at 15.50 Rand to the US dollar. And then that was broken in late February, early March. And the rand went all the way to over 19 Rand to the US dollar. There it formed a double top, and since then it has been strengthening. And as of this very moment right now, the rand is trading at 17.09 to the US dollar, which is a significant improvement. So we expect the rand to continue strengthening, which obviously has impact on rand hedge shares. Before COVID got going, when the first correction due to COVID started, we advised you to get into Process. And Process did extremely well for a variety of reasons, but one of those reasons was that, of course, it is a rand hedge. Now that the rand is strengthening, maybe you should reevaluate your position there, if you did take advantage of that. Anyway, the strengthening of the rand is solid evidence that the South African economy is regarded as one of the better emerging economies. Right, so now I just want to talk a little bit about commodities, and I want to start with the oil price. And there I'm going to look at the price of Brent, North Sea Brent oil. So just look at the chart here. Okay, here you can see North Sea Brent oil. You can see that it had a support level at $50.80 per barrel. And there was a clear downside break, which we drew to your attention in March. That downside break was obviously because of the surplus of oil as a result of COVID-19. The oil price eventually bottomed out over here towards the end of April at below $20 a barrel. And since then, it's been steadily rising. And you can see here that we are now at about $39 a barrel. And we expect this upward trend to continue as the world economy recovers. Most countries around the world are now showing a situation where they are reopening their economies and moving back towards a normal economy. And as they do that, they will consume more oil products and the price of oil will improve. And we regard the oil price as one of the best indicators of the world recovery following COVID-19. But of course, you mustn't forget that there has been a steady growth in alternative energy, and that battery technology and solar panel technology has jumped forward. And there was a report the other day of a solar panel which was almost 40% efficient. That is a massive step forward in solar panels, and will obviously make solar panels much more cost effective than they have been in the past, and oil will therefore appear to be less attractive. So we don't think that the oil price will continue rising forever, and it probably won't get back to the sort of pre-COVID levels, but it is on the upward move now. Looking further afield, the Minerals and Council of South Africa has been in a battle with the Department of Minerals and Energy over the third mining charter. And in fact, the Minerals Council has been taking the department to court, and there's been a huge fight over this thing. But the cooperation between these two organizations as a result of COVID-19 and their discussions about shutting down the mines first, then allowing them to operate at 50%, and then finally at 100%, those discussions have created a new atmosphere of cooperation and working together. And it now seems unlikely that those court cases will go ahead, and there's considerable optimism that the third charter can be resolved. The issues around the third charter can be resolved. Of course, the major issue there is the once empowered, always empowered principle. The department has been asking that new owners of existing licenses to mine would have to start the empowerment process over again. And that has been strongly opposed by the Minerals Council. And obviously that's very negative for anyone who's looking to buy into mining in this country. The Minerals Council says that the lockdown has probably cost us about 1/10 of mining production this year. But what we can say is, in general, mining is one of the sectors that has largely escaped from the impact of COVID-19. It is one of the better sectors. All right, let's look at some companies now. And I think before we start that, just a few words of general advice. As a private investor, you must be obviously looking for shares which have fallen heavily during the COVID pandemic. Some of them will return to their former levels. So you look for quality that is underpriced. And you need to consider their corona exposure. What exposure have they had, and what exposure do they still have to the legacy of corona? So I think that you need to avoid airlines, restaurant companies or companies that run restaurants, companies that are involved in entertainment, which involves gatherings. So any entertainment which involves a gathering of people should be avoided. So casinos, stadium sports, horse racing, cinemas, these types of events will probably never quite recover from what happened with COVID-19. The best companies are obviously the service companies and those which are involved in IT. Service companies typically get a large percentage of their income in the form of an annuity, and they got that income right through the lockdown. Other companies, for example, companies which have a shop front, literally had to stop in their tracks. They couldn't get any income during that period. Also, service companies and IT companies have found it much easier to convert to a work-from-home ethic, and many of them have actually achieved that and done that. But almost every share on the JSE has been impacted to a greater or lesser extent. So you need to try and determine the impact of COVID-19 on the shares that interest you. One of the casualties of COVID-19 has been Edcon. Although the business rescue practitioners say that there is some hope of recovery here. Business rescue has been brought in to replace what used to be called judicial management, and the objective is to try and get businesses back to profitability, businesses that are failing back to profitability. But roughly 2/3 of the businesses that go into business rescue fail. They are liquidated. But still, for the 1/3 that are successfully drawn back out of liquidity, this exercise is very worthwhile. And in the case of Edcon, as I said earlier, the business rescue practitioners say that it can be recovered, but they haven't indicated quite how. In our opinion, it seems unlikely because the clothing industry is so competitive. But one company that will recover from business rescue, in our opinion, is Comair. It should recover very well, especially if it can get what is owed to it by SAA. However, nobody quite knows how airlines are going to operate now that COVID-19 has occurred. And they may not be as profitable as they were prior to the pandemic. All right, I'd now like to look at Imperial. Imperial is a very large logistics and motor company, and it broke into two parts in 2018. On the 22nd of November 2018, it broke into two separate entities. Sorry, I just have to get this right here. Just want to show you the part after the break. So this is that part, and then what I want to do now is to put on a comparative relative strength. Comparative relative strength is a very useful indicator. It simply divides one data stream by another and draws a graph of the result. So I'm going to divide Imperial by Motus, right? So Motus is the company that broke away from Imperial, and that will show us the relative strength. Obviously, in places where Imperial was doing better than Motus, this chart at the bottom of the screen here will rise, and vice versa. So what you can see from this is that Imperial fell very steeply, finally after COVID-19 made a double bottom, and since then it's been drifting upwards or moving upwards. And you can see that in the initial period after the split of the two companies, Imperial really underperformed Motus. Motus was doing better. Remembering that Motus is in the motor trade industry, so they run motor dealerships. But with the advent of COVID, Imperial did far, far better than Motus. Because, of course, Motus had to close all its dealerships during the lockdown period and is only now starting to get them open again. So this is a very interesting use of the comparative relative strength. We recommend that you use comparative relative strength for anything that you want, where you want to compare one data stream with another. You can see it down here at the bottom of your screen. It's called CRSI at the bottom of your screen. Okay, let's look now at Signia. Signia, of course, is a company that's involved in gold or precious metals mining, and they have been doing very well recently. You can see that the share has been trending up, and then there was the COVID-19 impact, the bear trend, but they have substantially recovered from that. But Signia has done something very unusual, especially in the precious metals market. They've made two brilliant acquisitions, two absolutely brilliant acquisitions, which involved enormous risk. The first one was that they bought the Stillwater mine in America, in Louisiana in America, for $2.2 billion, and that saddled them with a huge debt. But that debt is now paying off because the price of of PGMs, and particularly palladium, which is produced by Stillwater, has been rising very sharply. The second risk which they took was the purchase of Lonmin. In this case, they didn't pay cash. They bought Lonmin for 4.3 billion rand, which was paid in Signia shares. But, of course, when they did that, they took on a huge risk because Lonmin is the mine which was involved in the Marikana massacre. And so it has a very bad reputation with the community and a very bad relationship. But that event has also paid off handsomely. In fact, in the most recent results for the March quarter of 2020, Signia generated 11 billion in earnings before interest, taxation, depreciation, and amortization, or EBITDA as it's known. and they managed to drop their debt very sharply. And a lot of that was because they own the Lonmin mine, which has now been renamed Marikana, and they've got it working very well. They're now reinstating their dividends, and it shows that both of these gambles have paid off handsomely. And that is largely due to the CEO of Signia, Neil Froneman. He had the foresight to pick up these mines at very low levels, and he is now benefiting from that. Corona has impacted on the share, but that is rapidly becoming part of its history, as you can see from the chart on your screen. The next company I want to talk about a little bit is Mixtel. We have always encouraged investors, private investors, to look for service companies rather than companies that are in manufacturing or some other kind of heavy industry. The reason is that these companies typically have a high level of annuity income, and they also have very low working capital, which means that they're not carrying a large debtors book. They don't have a lot of money tied up in stock. They don't usually have to invest heavily in buildings and land and plant and machinery and things like that. So they are very low-risk businesses to run, and they are usually very easy to run profitably. And they have benefited in this COVID-19 pandemic because that annuity income has just kept on coming in, even through the lockdown, whereas other companies have not had that benefit. Mixtel is one of the best examples of a service company that has most of its income in the form of an annuity. It is obviously offering tracking devices on vehicles, and it does that all over the world. It's got a very worldwide marketplace. In the year to the 31st of March 2020, they added 68,000 new subscribers right around the world. Their subscription revenue was up by 9%, and that's solid. That income is solid in the face of COVID-19. Institutions are beginning to notice Mixtel. It has had very low volumes traded, but those volumes are starting to pick up. And it's now starting to get to the point where its volumes are at about 300,000 rands worth of shares changing hands every day, which shows that institutions are starting to get involved. As they get involved, we can expect this share to recover very rapidly. All right, now I'd like to look at Old Mutual, or OMU, O-M-U. Old Mutual, of course, is a huge blue-chip African financial services company. It is what remains after Quilter, Brightsphere, and most of Nedbank was split off from the original Old Mutual, which was listed on the London Stock Exchange. The estimate is that Old Mutual, as it stands now, has an embedded value which is approximately 30% higher than the share price. The share price is currently, as of last night, is trading at about 1,200 cents a share. And at this level, it's trading on a price-earnings ratio of 5 and a dividend yield of 8%. This is a high-quality blue-chip share which has 1.1 trillion rand under management, which makes it a massive asset manager. It still owns 19.9% of Nedbank as well. It sold off its Latin American businesses, so its business is really now in 13 African countries. But at this PE and dividend yield, it looks like very good value to us. The next company I want to talk about is MAS, which is a real estate investment trust. This company is involved in property in Europe and the UK. They own commercial, industrial, office, and other warehouse space in Europe and the UK. They've been selling off their assets in Western Europe and focusing on Central and Eastern Europe because that's where the growth is. The company was started and is run by Martin Slabbert and Victor Semyonov, who started Rockcastle. So if you know anything about Rockcastle, you'll know what a howling success that was when they started it. The company has recovered now, or is recovering from, the COVID-19 restrictions in most of the countries where it operates, and its asset value has tripled since it started in 2016. So we regard this as a very good rand-hedged share that is underpriced at the moment and one that is worthy of your attention. The last share that I want to talk about is Signia. Signia is a specialist financial services group. It's South Africa's largest supplier of ETFs. It has assets under management of 238.4 billion, which is up 7.1%. In the year to the 31st of September 2019, this company increased headline earnings per share by 27%. Recently, in a trading statement for the 6 months to the 31st of March 2020, they said that headline earnings per share are expected to rise by between 86% and 105%. And the share is sitting on a dividend yield, as you can see here, of 4.8%, with a PE of 13.4, which looks to us like very good value. It's quite similar to Coronation, where Coronation was in 2012, early in 2012, when they had just started out. At that stage, they were sitting also with a dividend yield which was very high. And over the next 3 years, 4 years, that share went up 400%. So we think this Signia could be another Coronation. Folks, that's about all I have for you this month. Otherwise, I can just say that it is a time to pick up shares when they are cheap and to be safe. I'll talk to you again next month.